overview of what is corporate tax, distinguishing it from some other issues or taxes. And then we have Chapter 2 that deals with formation issues, a code section near and dear to many of us, which is 351, right? And when transactions are going to be taxable. Keep in mind it's something that you're going to have to know for the final exam because the course is cumulative. And we have code sections that get triggered, 351, 358, 362, 1032, a whole string of different code sections. That's all spelled out in Chapter 2, including the receipt of boot. All right? And what are the tax implications about boot? What are the tax implications? Thank you. What are the tax implications when you contribute property subject to liabilities? Hopefully, this is becoming easier and easier, at least my aspirations. Chapter 3 deals with capital structure issues and the differences between debt and equity. And when a corporation is formed, sometimes it's formed with some debt, some equity, sometimes lots of debt, little equity. And when that works, when it doesn't, what are the tax implications? The second part of the chapter, what are the tax implications if and when there are losses? It's one of the few times you'll see when it comes to Code Section 1244 stock that you will actually get an ordinary loss treatment associated with the sale or disposition of a capital asset. Subject to limitations, of course, but if you're one of those people who say, gee, you're stuck here with capital loss, and you don't call to your attention to your client 1244, and your client subsequently finds out that, gee, they would have qualified for ordinary loss treatment, they're not going to be happy campers. And then if they're not happy campers, you won't be a happy camper. So then we moved on, guys, and we spoke about Chapter 4, non-liquidating distributions. And the title of this chapter, there's a clear message here. It's not called Chapter 4 dividends, right? And what are their consequences? Because we have our three-tiered structure, right? We need first, this chapter, takes a digression. The digression it takes is to examine the earnings and profits, right, of the corporation, because without knowing the earnings and profits under Code Section 312, it's hard to know what are the implications to the shareholders under 301C 1, 2, and 3, right? So that's spelled out in Chapter 4. They talk first about, again, computing earnings and profits. Then they look at distributions of cash. That's pretty straightforward, followed by distributions of property. And for the first time as a class, we get a glimpse of Code Section 311. And Code Section 311, we know, is one of those pivotal code sections, right? That is one where the government wins if there's gains, and the government wins if there are losses because the losses are disallowed. So it's a very pivotal code section for our purposes. And we also looked, as you guys know, Matt, right, that we don't only look at the gains and losses under 311, but we also look to the effects of the corporation, including its earnings and profits, albeit it's not truly a tax concept, but it is under Code Section 312, and that would be a more complete answer, right, Matt? All right, thank you. Then you spoke on page 168 about constructive distributions, because sometimes corporations, at least in yesteryear, would try to camouflage their distributions. In yesteryear, meaning when distributions weren't taxed at, dividends weren't taxed at 15%, there is an attraction to try to, and there still is, to the extent that shareholders who get yachts and other things or the use don't include anything in income. Towards the end of the chapter 4, there's a discussion about so-called anti-avoidance limitations, because anytime you're giving 70% deductions or 80% deductions or 100% deductions, those are real magnets, right, for tax planners. In the form of Code Section 243, the dividends received deduction, and there are several limitations, right, for the application of those rules, right? There's several limitations that the code imposes so that taxpayers and us tax planners don't go hog wild trying to avail ourselves of the dividends received deduction. And those are spelled out at the end of end of chapter 4. We moved on, and we spent a good portion of last class talking about redemptions, right? And we will begin today to talk about partial liquidation. So let's just get back into the frame of mind of redemptions under chapter 5. Chapter 5 talks about this concept of redemptions, which we saw for the first time. Andrew, can you tell us globally what is this whole chapter about? What different paths may we take when we're doing an analysis when a company buys back its own shares? Off the top of your head? What's this chapter about? Say it louder. Right. Whether the redemption will be treated as an exchange, taxable under Code Section 1001, or will be treated as a distribution, which throws us back into chapter 4, right? So it's pivotal that you see, right, Andrew, the bigger picture. The bigger picture, because if you don't have a good handle on the big picture, forget about the minutia, right? And the operative Shahid code section for this is? If you drop the I think part, that's good. 302, right? Just, again, you want to impress people at the cocktail party. All right, 302, right? And when you look at code section 302, which we, I guess, should all have open, talks about the general rule and what to be a true redemption, meaning qualify for exchange treatment. Dion, how would you explain it to clients? Right. I mean, most of our clients, unless they're corporate shareholders, if they're corporate shareholders, they may have a different agenda. But our individual shareholders will generally prefer exchange treatment. They get to use the tax basis. They get capital gains. How do they get to the promised land of exchange treatment? How do they get there? In other words, you said it's advantageous. I'm your client. Well, show me the way. Just what should we do to make it happen? What are some of the tests, Dion? Where do you find the tests? 302B, right? And if we want assuredness, Chloe, what code section would you point to? Excuse me? Well, you're right. I mean, before we do our analysis under 302, right, we have to take a digression, right, 318. And we have to tell who's who among the players, right? And 318 is pivotal, right? We all know that, right? 318 will explain attribution rules because it's not only what we actually own, but it's what we constructively own, right? So assuming we apply 318, then Chloe, what is the mechanical test? Where do you find it, and what does it say? And what does it say? Okay, there's a less than 50%, and then there's two separate 80% tests, right? Okay, that's the mechanical test. And then if we want, Edwin, another test would be what? That we might want to rely upon. Well, I'm saying, aside from 302, B2, what's another common test? Christy? 302 what? We got to stick with the B part, right, Christina? B what? B3, right? Which talks about what kind of rule is that, Christina?
It's substantially.
No, that's B2. It's our Schwarzenegger rule. Termination rule, right? Termination rule. And to get to the termination rule, Irina, can you do that? Are you given any crutches? Any handicaps? Lee, are you given any handicaps? Does the code give you a gift here? Well, B3, but Jared, is there any peanut butter and jelly here that you can look for?
302C.
302C what?
302CA,
I think you're skipping a number there, right? 302C2, A, and you go from there. That we can waive family attribution rules, which may be critical, right, to succeeding in a termination, right, under 302B3, right? And then, if we can't make it under B2, we can't make it under B3, Akash, what are we left with? B1, which, can you just paraphrase what that means? Janine, can you paraphrase it? Essentially equivalent to a dividend. So what does that mean? What do you look for? Right, the most critical factor is voting rights, right? Everyone agree? 302B1 is sort of our gray test where we say it's not essentially equivalent to a dividend. Keep in mind, when you get dividends, does your relationship to the corporation change? Generally, no, right? But when you engage in an exchange where you give up stock and you give up something meaningful, then that is something where your relationship to the corporation has changed. I don't know if the team knows. We can all listen to our conversation here. So 302B1 is something that we may not be able to easily rely upon, but in certain circumstances, there's a whole slew of revenue rulings and the like that we may. Bad blood. Does that work, Matt? Right. Doesn't really change anything. So at least there doesn't look like that's going to be a safe harbor. All right. So thus far in Chapter 5, guys, we looked at the constructive ownership rules. We applied Code Section 302B2, then B3, and we left off with a discussion of B1. If things fall into place today, I'd like to continue our discussion of 302B1, then move on to partial liquidations under B4, and talk about the application of these rules, where they really apply. And I think we should get towards the very end of the chapter. I'm not sure if we'll finish. And then for Saturday, we'll finish this chapter and we'll finish Chapter 6. It shouldn't be a problem. So at least that's my aspiration. Right, Michelle? Yes. We're going to do it whatever it takes. Okay? We've got to give you guys the complete life cycle of a corporation. That's my commitment to you. Now, speaking of my commitment to you, go ahead, Kate. See, I've learned in life, guys, that if I want fast response, I send out emails 95% of the time. I never hear a thing. But in this case, I sent out an email at like 7:30 in the morning, and then I get 5 responses. So you guys do exist out there. And very quickly said, essentially, 7:30 is a non-starter. So, thank you, Shahid, for giving me the segue to say we will start the exam at 8:30, and we will go at 11:30 if anyone's interested. At least now I had my secretary type up a list. And let me apologize. She used your handwriting. This wasn't me. So several of your names are misspelled. But, forget about placards. I also believe in name tags, these kind of things. So spell your name correctly, please. But there's 35 names. If you can't make it, like all of a sudden your plans changed and you can't come to Kilkenny's, which I Googled it. Google Maps. You know how far Kilkenny's is from the front door? It's less than 500 feet. I know that's going to be tough for some of you, all right? And I'll Google you those directions, all right? But if you can walk 500 feet, we can all meet at Kilkenny's at 11:30. And if you want to bring a guest, just include his or her name, or I guess there could only be a his or her. Well, I got to be careful. Maybe not these days. But if your name isn't on this list, and you want to join us, just let me know. Okay, so just add your name on the bottom or on the back. Okay, good. Shahid, did I answer your question?
Yeah.
So, all right. So let's see if we can make this happen. Now, other questions? Michelle, you're good. All right. So before I go on, movies, anyone? Everywhere I turn now, I can't get away from it. I don't know, like, I knew he was in, what was the movie? Brad Cooper was in, what was the big one? Hangover. But now I realize he was in a movie called, like, Listless or something like that. Anyway, everywhere I turn, this guy is turning up. Any other movies? It was a nothing movie, in my opinion. It was a... What movie? Corporate Tax, okay. My son saw This Is the End. Someone else saw that. Allie, did you see it? He thought it was funny, but not over-the-top funny. All right. Anything else aside from Corporate Tax? Superman. How was Superman?
I enjoyed it.
Who stars in that?
I think I did that into Superman. Yeah, but it was good.
Okay. Anything else? Who did? And what did they get indicted for? Oh, really? Okay. Somehow, I usually catch these things, but okay.
I think it just came out.
Oh, wow. Look at that, cutting edge. All right. Someone else saw Broken City, but the reviews on Rotten Tomatoes on that was not that good. Did you like it? Okay, and the person who saw it, I forget, was right here, but I don't...
I saw it.
You liked it, right?
Yeah, I like that. It's so flat out. It's long.
Really? All right, there you go. All right, back to redemption. All right, so what the authors do, guys, if you recall, is when we're going through 302B1, they try to give us an overview, all sorts of examples, because it's not a very clear test, right? And I will call to your attention, if I can, motive doesn't matter. U.S. v. Davis, motive does not matter. Motive does not matter. And then at the bottom of page 230, just like Janine said, on the bottom of page 230, we talk about various factors: the right to vote, the right to participate in current earnings and profits, and the right to share in net assets and liquidations. Those are all things to consider, right? And we spoke, let's just review what we had on on page 235. We have Z Corp has 100 shares outstanding owned by A, B, C, and D, and the number of shares are spelled out. Unless otherwise indicated, assume the shareholders are not related in each of the following alternate situations to determine whether the redemption is not essentially equivalent to a dividend, right? And if you recall, when Z redeemed 7 shares from A, I just want to remind people your notes. One thing in your notes that everyone has, of course, is that reduce the denominator, because how many shares are outstanding, Anta? If you have 7 shares that are redeemed? 93. And if there's a mistake that people make, a common one is they do not reduce that denominator, all right? And that's not where you want to be. And we said that in that case, in problem A, we have our taxpayer going from 28 to 22.5%. Can't act in concert. Probably will qualify under 302B1 for your notes, right? Question B, 1B. We redeem 5 shares from A, and now A and D are mother and daughter, right? And the attribution rules under 318 apply. And before there was 52%, after we dip below 50%, but we have in your notes perhaps a question mark, right? Who owns the other percentage of the company, because that may or may not be meaningful, right? If there's one shareholder or if there's a million other shareholders, can have a bearing on whether 302B1 applies. Question C. Z redeems 5 shares from A, and A and B are mother and daughter. And it goes through a similar analysis, but this time we didn't dip below 50%, so we know this can't possibly qualify under B1, right? In question D, I think it was you, Fanta, who answered that you would be disowned if you married outside the faith, and notwithstanding that, it wouldn't matter for 318 purposes, right? All right, so everyone has their notes on this. Everyone can deal with, again, one of the things I pointed out to you when we were going through the issue under 302B2, if you recall, I forewarned you that even though a transaction doesn't qualify under 302B2, I said that in your notes, put a parenthetical, may it qualify under B1, right? So even earlier in this chapter, when you dealt with 302B2, keep that in mind. And even if it doesn't qualify perhaps under B3, it might qualify under B1. So B1 is one of those things that if you have nothing else to work with, maybe it will work. All right? Question 2. Y Corporation has 100 shares of common stock and 100 shares of non-voting preferred outstanding. The preferred stock is not convertible into Y common. It is not Section 306 stock, which is stock we'll soon learn about next class. The Y common and preferred stock are owned by the following unrelated individuals. Unrelated is not just there for the author's health. It's there to just confirm that you don't have to worry about the attribution rules. Will the following alternate distributions qualify for exchange treatment under 302B? Y redeems 5 preferred shares from E. Okay, 5 preferred shares. Guillermo, does that qualify? And Larry, see if you agree. Redemption of the 5 preferred shares. Just say it louder. Well, Larry? We didn't go through it, so you didn't have to remember. Shirley, what do you think? Not sure? John? Say it louder. Does not qualify. Why? Brian, do you agree? Do you have any authority? JP, you agree?
Yes.
So this would qualify as what? What would this be treated as? Is that how you would, in conversing with the client, is that how you would refer to?
That would be,
Andrew, tell me. That's what a redemption is, but is it? Be careful, because if you don't mind, I'm being harder on you than I should be, but if I'm not, no one will be. You're being sloppy with your language, because you're calling it a dividend. What is it called? The distribution, right? Because you can get into trouble, and I'm trying to save you on the exam or with the client getting into trouble. Just don't jump to the conclusion it's a dividend, right? It's a distribution, and we'll decide, right, how 301C 1, 2, and 3 applies. All right? So, is that what you're saying? Should be treated as a distribution? Do we all agree? Does anyone disagree? And why do you say exchange? Yeah, 302-2A says what?
Any redemption of stock for shareholder, only non-voting preferred is not essentially equivalent to dividends, since the shareholder does not have control over whether the redemption occurs.
Just say it louder.
Anyone who has just non-voting preferred is treated as not essentially equivalent to dividends, since the shareholder has no control over whether the redemption occurs.
So this is 302-2A. In other words, this shareholder, hey, Jean, did this shareholder feel any pain when they had 5 shares redeemed? They had no comment. So did they give up on a going forward basis? Do they feel that, like Bill Clinton, I feel your pain? You feel the pain here? Does this qualify for exchange treatment? Yes. There's a regulation right on point, right? And it makes sense because this shareholder has given up something very meaningful on a going forward basis, right?
what is the regulation?
302-2A. Okay, Christy, you're on a roll, and we'll see, Carolina, if you agree. Suppose all the preferred shares are now taken out of commission. Suppose all the preferred shares are taken out. What happens in that instance? Just say it louder because people like Ryan up there, Kenneth, can't hear you.
This is not proportionate equals exchange.
To all of them? Okay, and Carolina, do you agree?
Yes.
So you're going to treat it as an exchange as to all.
I would, yes, under
302 what? 302B1. Is that you take it? You would just, if you're talking to a client, say treat it as an exchange as to each shareholder under 302B1. Let's just take a look at E. Would you say to 302B1 on that one? On taxpayer E? Yes? No? You're thinking Schwarzenegger, right? E's been terminated. Everyone agree? So you can say B3. Right? Now. No? A never had any shares redeemed, right? No, because question A, we already said that qualifies for exchange treatment, but he didn't have all his shares redeemed, right? That just fell within the scope of 302-2A. Now we're in question B. And we're just talking about the effect of E of having all of his or her shares redeemed, and we said been terminated, right? And it doesn't apply to taxpayer A, right? Because A had no preferred shares redeemed, right? Everyone agree? Everyone with me, right?
I want to go back to A. Why are we saying that this is an exchange treatment?
No, we're not. A had nothing. A didn't give up anything. A had no preferred shares.
I think she put a letter A, not A.
You mean question 2A?
Question 2A.
Oh, that's 302-2A. In your notes, it's regulation 302-2A that the taxpayer, the regulation makes clear in this kind of instance where the taxpayer will only own preferred stock would be considered as if this were exchange treatment. Look at that regulation when you get a chance, okay? They only own preferred. So here they had a meaningful disposition that would qualify for an exchange. Now let me get back to all the preferred are redeemed, okay? Everyone with me? And what does preferred stock mean? Not from a tax perspective, from a corporate governance perspective. And, it earns the moniker preferred because if there's earnings, those earnings first get paid to the preferred, and if there's anything left, gets paid to the common. Agreed? Now, we're all very imaginative in this class, right? So let's use our imagination, and let's suppose that the first $100 that this corporation earns each year gets paid to the preferred shareholders as a dividend, and whatever's left gets paid to the common. Everyone agree that's a sensible? So when you think about it that way, so let's say in the year 2012, before the redemption, the first 100, B got $55, C got 10, D got 15, and E got 20. Agreed? All with me on this? Now, next year, January 1st, 2013, all 100 of the preferred shares are redeemed. So what happens to that $100 that I just spoke about? It will be divided up amongst the common shareholders. A will get $40 of that. Agreed? Now, does B feel better or worse as a result? How much? Ooh, worse. Would have gotten 55, now he's only getting 20, right? So feels like that's a meaningful change, 302B1, right? Everyone agree? Because he's really going to, on a going forward basis, he's going to get less. And that, to me, is significant, right? Because usually when you get dividends on a going forward basis, you don't do better or worse. You do the same. He's going to do worse. Joanne, you see that? Okay.
What's the answer?
Hold on. So B, we just said, is going to do worse. How about taxpayer C? Does C? C's got a smile on his or her face, right? Because C's going to do better this year, meaning 2013, because instead of getting $10, C's going to get 25. Does this feel like an exchange if the next year you're going to do better as a result? Probably not. And our other taxpayer D, going to do the same. Chances are that's not going to qualify because if you're doing the same as you were doing before, that's not a meaningful change, right? So, look, there's no crisp answer here. I think the authors are having some fun, but they're trying to show you that they're trying to say, take it the next step. What would happen if you redeemed all the preferred shares? There could be different effects to each shareholder depending on their circumstances, right? And the key here is what's going to happen on a going forward basis. Are they going to do better or worse vis-a-vis their remaining stock ownership? If they're going to do better, it doesn't feel like an exchange. If they're going to do worse, that means that it probably signifies that they did give up some of their ownership in the company in a meaningful fashion. So we said E will qualify for exchange, and B will, and C and D probably will not. All right, everyone have that? A is a non-event. E has definitely got exchange treatment, emphatically, and we're saying B likely would, and C and D would likely not. Everyone good with that? Say it.
In terms of the fact that it's voting, that only matters for section 302B1, right? As opposed to non-voting.
Well, voting also plays a role in the mechanical test of B2, right? So I'm not sure what your question is.
Oh, wait, it's just more along the lines of if this was something that would qualify under 302B1, then it would matter whether voting stock or non-voting stock is being paid, right?
Voting is just one of many elements to consider when you're doing a 302B1 analysis. It's an important one, but I don't want to say you just look at voting. Okay? Because in E, person E didn't have any vote, and we still might be able to fit E under B1. Okay, question 3. Suppose an individual shareholder owns 10 shares of common stock of X corporation with a basis of 15,000. What happens to the shareholder's basis if 5 shares are redeemed in a transaction which is properly classified as a, I should say, distribution instead of the word dividend? But look, maybe the author is assuming the company has a lot of earnings and profits. Okay, so if that's the case, the shareholder owns 10 shares, 5 are redeemed, but it doesn't qualify for whatever reason. In that case, Michelle, what happens? Did you? What do you think might happen to the basis that they had in those shares that were redeemed? Irina? Jarrett?
Basis just change the dividend. Their basis total of the stock will half, it's just like half the share.
So what happens in this instance? How would you articulate it to the client? Lee? Does the basis in the shares just disappear? No. Where does it go? It goes back to the shares that remain. It stays with the shares that the shareholder owns. If you want authority for this, guys, just take a look. I mean, nothing could be clearer here. You got to read this stuff. 302-2A, examples 1 and 3. Okay? 302. Let's just look at your reg book. Look at the reg portion. Okay? 302-2C. I cut it off. 302-2C. If you look at examples 1 and 3 here, guys, it's our identical fact pattern. The basis just swings over to the shareholder's remaining shares. Okay? What happens if all 10 shares are redeemed in a transaction properly classified as a dividend? Okay. So now, thanks. What happens now if all 10 shares, Howard, are redeemed? What happens to the basis, Kareem? What happens to the basis in those shares? That reduce the taxpayer no longer owns shares. You have 10 shares, they're all redeemed, but your wife owns the remaining, so it doesn't qualify for redemption treatment. What happens to the basis in your shares? Hold on, say again, Howard? Kareem? Well, remember, the wife is not a new owner. She's been there. Gets transferred to the related party. Now, keep in mind, that's what the existing regulations say, and that's nice because that's what they do say. And that's example 2 in these regulations. The new proposed regulations would treat that as a suspended loss, believe it or not. The new proposed regulations would treat this as a suspended loss and would wait until there was a subsequent event in which the wife or related party disposed of his or her shares. Okay? let's just, for test purposes, take the regs as they are today. Okay, meaning they would swing over to the spouse. But I'm just telling you, in a year or two or three, it's great to have your old notes for a class, but if you're ever, if you're practicing tax, guys, your go-to place to give your final answer to a client would not be your old tax notes, partnership tax notes, or the like, right? Things are always in constant flux. So Howard, you had a question. He, in this case, he, meaning you, don't own any more shares. That's it. It's zero. Albeit, like I said, under the proposed regulations, you would have a suspended loss, and you would get that loss subsequently when there's a what they call an inclusion event. I think that's what the regulations say. The proposed regulation 302-5A3. I'll repeat. Proposed regulation 302-5A3. The new. The existing regulations are just the ones I cited you to, example 2. If you look at example 2 in the regulations, it has it. All right, so guys, we have covered 302, B1, B2, and B3. A lot of suspense in the crowd about B4, but here we go. All right? B4 deals with partial liquidations. And I'm going to telegraph for you another thing that students often, Ryan, make a mistake when they deal with partial liquidations. What do you think they do, Ryan? To what kind of taxpayers do you think they apply the rules of B4 and then they get it wrong on an exam? Thank you. Say it louder. They apply it to corporate shareholders, and I've seen it so many times, and if I could speak through the paper to you, like a mini seance of sorts, I would, but I can't. But just know in advance, if you don't do that well, you probably didn't listen to me, right? I just emphasized that partial liquidation do not apply to corporate shareholders. So that if you have a corporate shareholder, this is a corporate shareholder owning stock in a corporation, right? This shareholder cannot qualify for exchange treatment, right? And we'll see what I mean in a second, but keep in mind, look at the phraseology of 302B4. It says redemption from non-corporate, and I have circled in red, N-O-N, non-corporate shareholder. Wow, our list is growing. Although I thought our list was growing, but some people are just correcting the spelling of their names. Oh, it's growing. That's good. All right. I'm very excited that we can break bread together. I don't know how good it will taste, but we'll see. All right. I'll keep you posted. I'll type up this list one more time to make sure we get everyone's name spelled correctly. And just last minute, if you can't make it, let us know, because Rutgers will pay by the person. So if you can make it, great. If you can't, better to know in advance. But all right. So 302B4 talks about, and again, next time I pass along the list, anyone who wants to bring anyone, that's more than happy to meet your significant others. In a partial liquidation, what is a partial liquidation? And like much of the code, guys, this is not left for guesswork. Right? It's not where you think it's partial liquidation, but I don't think it is, or vice versa. 302E is entitled partial liquidation defined. Right? It says, for purposes of subsection B4, a distribution shall be treated as partial liquidation if conjunctive conditions, right? You got to meet capital letter A and B. The distribution is not essentially equivalent to a dividend, and this is determined at the corporate level. Notice that parenthetical. We're not looking at the shareholder level to see if there's been a meaningful change in their ownership, right? We're seeing if this corporation, and you guys will appreciate the artwork here, right, is now a smaller entity, right? So you see how that square got smaller? That's because there's been a partial liquidation. We're not looking at the shareholders, right? B1, B2, and B3, we were examining the people on top, right? And seeing what effect the redemption had to them. With the B4 analysis, we're looking at the effect at the lower level. Okay, so for your notes and as you're summarizing and outlining for the exam, I don't care what you do to call attention to, make sure you say when you do your B4 analysis, you call attention at the lower level, right? And the analysis for B1, B2, and B3 is at the upper level. So it must be not essentially equivalent to a dividend, determined at the corporate level, and the distribution is pursuant to a plan that occurs within the taxable year in which the plan is adopted within the succeeding taxable year. There has to be a termination of business, okay? The distributions which meet the requirements of 1A shall include, but not be limited to, okay? So can also go beyond this, and we'll see in a moment what that means, which meets the requirements of A and B of this paragraph. Okay, so it has to meet both. The distribution is attributable to the distributing corporation ceasing to conduct or consist of assets of a qualified trader business. Immediately after the distribution, the distributing corporation is actively engaged in the conduct of a qualified trader business. And what's a qualified trader business? It's defined right below. Means any business which was actively conducted throughout the 5-year period ending on the date of redemption. So there's a 5-year, it's got to be active, it can't be passive, and it wasn't acquired, this active trader business, in a taxable transaction within the past several years. What is the effects? On one hand, if there is a partial liquidation, it's a non-corporate shareholder, they will get exchange treatment. If it is a corporate shareholder, again, for your notes and draw connections, what code section gets triggered? The extraordinary dividend rules, right? Code section 1059. This is spelled out on page 238. That's the first full paragraph on page 238. Any amount treated as a dividend to a corporate shareholder under section 301 is, quote-unquote, an extraordinary dividend under code section 1059 if it's a distribution or redemption of stock, which is part of a partial liquidation. So anytime you have a partial liquidation, you have to draw the connection. If there's a partial liquidation and you have a corporate shareholder, by definition, the extraordinary dividend rules apply under Code Section 1059. So what that means is the non-taxable portion will cause a basis reduction of what this corporation's basis is in this corporation. And some of the stuff you'll need to see by way of example. Unfortunately, one of the strengths of this book, you may say there's many weaknesses to this book, but one strength of this book, I like to think, is the examples are pretty good ones that the authors offer up. Revenue ruling 79-184 talks if you have a parent and a subsidiary and talks about two different scenarios, this revenue ruling. What happens if the parent sells the stock of its subsidiary and let's just say gets $100,000 for selling the stock to some third party? And then the parent company has extra $100,000 of cash, right? It sells the stock of the subsidiary, has an extra $100,000 of cash. And it distributes that cash to its shareholders. Will that qualify as a partial liquidation? And compare and contrast that with, okay, so scenario one is the parent sells the subsidiary, gets cash, and then distributes the cash. Compare that to the parent liquidates the subsidiary, so this is supposed to be a bigger P, right? Because now S is sort of embedded in the parent. You get the visual on this? Suppose the parent liquidates the subsidiary, liquidates the subsidiary into itself, which is not uncommon. And then distributes out the assets of S. Okay? Distributes out the assets in a partial liquidation, because once it does that, then P will once again become smaller. That's scenario two. Do either of these work as a partial liquidation? That's what this revenue ruling is driving at. If scenario one, if you simply sell the stock and get cash, and you distribute the cash, does that qualify as a partial liquidation? And the answer is no, it does not, right? Does not. Compare and contrast, and let me just give you some foreshadowing about liquidations in general. When a subsidiary is liquidated into a parent company, guess what? It is not a taxable event, okay? It is a non-taxable event. Just like 351, it doesn't feel like much is different, right? If you had a subsidiary here and it's liquidated into the parent, the government doesn't have to worry about leakage. So all the attributes of the subsidiary and its assets are captured in the parent. So that being and you'll see this when we talk about Code Section 332 and 337 in 2 classes from now when we talk about liquidations, that this is generally tax-free. In this event, if the assets of the subsidiary are now distributed out to the shareholders as a partial liquidation, this revenue ruling says that works. That will be a bona fide partial liquidation. Okay? So those are 2 different scenarios. And that's what that revenue ruling. If you're advising clients on how to secure partial liquidation, you want to say liquidate, you might say, gee, you get to the same end. But form here is important. And sometimes the IRS says you can't elevate form over substance, but here we have a roadmap where the IRS, through a revenue ruling, says form is so important, we'll respect this if you go through this exercise. So if the IRS says it can be done and gives its blessing, let's not turn our backs on it. So good tax advice would be, don't do this, do this. Don't sell the stock, but liquidate first and then distribute the assets of the subsidiary. Christina?
So I just want to make sure you said the first example where it does not work. The parent, what happens exactly? They sold the stock to the subsidiary?
Yeah, they just sold. They had 10 shares. They sold all 10. They got $100,000 out of cash, and now they said, "Oh, we're smaller." Doesn't work. I'm sorry?
When the parent distribute the money, when they sell the stock.
Who's they? Be careful.
When the parent company sells the stock to the subsidiary.
Right.
What will be the consequence for the parent company?
The parent will have exchange treatment under Code Section 1001.
It will have exchange.
It will, but now it's going to liquidate. It's going to have that $100,000, and it's going to say, "Gee, we're going to distribute out that $100,000 in partial liquidation to our 2 shareholders." Right? We have 2 shareholders here, A and B. The problem is with A and B, when they get this $100,000, it's not going to qualify for exchange treatment to them because it's not a partial liquidation under B4. All right? Hold your thought on this, because let's go through this example, because this problem on page 240, and I think, I'm not sure, Irma, if this doesn't help you, then, well, because this illustrates the application of this revenue rule. We have Alpha Corporation, operates a book publishing business, books, and a bar review course, CRAM, as divisions, not separately incorporated entities. Alpha's single class of common stock outstanding is owned in equal shares by Michael, Pam, which is Michael's wife, and Iris Corp. Neither Michael nor Pam owns any stock in Iris. Alpha also owns all the stock of Beta Corporation, a separately incorporated company which is engaged in whatever the heck Beta processing business is. And it directly owns its diversified securities portfolio. So, again, I am no artist, but in the margins of my book, which I would imagine you guys would have as well, you have in big letters Alpha. And Alpha, we're going to divide. It's one company, but it has a bar and it has CRAM, right? Two divisions, right? Everyone agree? And it's owned three different ways. Right? By Michael, Pam, and Iris. And we're also told Alpha owns a subsidiary, Beta, right? And for lack of my ability, I have sort of this amorphous, I don't know what kind of shape you want to call it, securities, right? Because it owns a whole bunch of securities. Everyone agree? These securities are really owned by Alpha here, but I just set them off as, they're just, it's not a separate entity, it just owns a bunch of securities. The corporate structure it's owned by three shareholders. Alpha itself is the parent company to Beta. Alpha owns a whole bunch of securities. Right? Are we told that? And it directly owns a diversified securities portfolio, right? What are the shareholder level consequences of the following alternative situations or transactions? So, what are the shareholder consequences to these three shareholders, right? That's what we want to know. Alpha operated Book and CRAM for more than 5 years. It distributed the assets of books to its three equal shareholders in redemption of 50 shares of each shareholder, okay? So each shareholder here supposedly might have 100 shares, and now the assets of books are being distributed. Instead of each having 100 shares, they're each going to have 50 shares, right? Let me get the visual on this. So, in this case, does this work? Anna, Brian, does this work? Yes. Let me just, Hannah? Doesn't work. And Brian, be careful. Well, go ahead, Brian. I'm sorry? So what do you say to the shareholders here? Non-taxable? Why would you say that? But remember, an individual is far different than a corporate shareholder, and it's not a liquidation of a parent into a subsidiary. We're just getting rid of a division. right? So in this particular instance, Gregory, do you think this might work? You don't think it works? Duran, do you think it works? Paul, you think it works? Dion? Chloe? Eeyore? So you're satisfied, it works. Mercy, you there? You sure? Green? Let's say green. Fine. M&P, but we cannot say, at least guys, if it works, what about Iris, corporate shareholder, right? Do we want to say again? Well, does it work, Eeyore, to M&P? Sure. All right, everyone got that? Iris, when we get rid of bar here, okay, and we distribute up its assets, right? It will work for M&P. They'll get exchange treatment on their 50 shares, right? Right, Andrew, this gets back to our first thing we spoke about, this chapter. They want exchange treatment, right? But as to Iris, what code section gets triggered, Tyler, in this context then? And here, Whispering's 1059, right? Everyone agree? So, with respect to, if you look at code section 1059E, let's just open it up, just so you can remind yourselves. (1059E1), without going through all the detail here, essentially makes this accepted as otherwise provided in the regulations, which we're not going to worry about. In case of any redemption of stock, which is a partial liquidation of the redeeming corporation, which is not pro rata as to all shareholders, and then it goes on from there. But the point I'm going to just make is that the rules under 1059 will cause the basis that Iris has to be reduced by the dividends received deduction. So whatever amount it receives, assuming it qualifies as a dividend, assuming there's adequate earnings and profits, so the amount it receives, let's say $100 worth of these assets, BAR's assets, that would trigger a 70% dividends received deduction, right, in this context, because Iris doesn't own 80% or more. And that being, or doesn't own 20%, well, could qualify for the 80% dividends received deduction. But whatever the dividends received deduction is, causes a corresponding basis reduction. So for Iris, guys, doesn't qualify as a partial liquidation. With respect to M&P, this would qualify. Why does it qualify? Because we meet the definition under 302E. We have an active right EHOR trader business for 5 years. CRAM is going to continue. So it's not a liquidation of the whole, right? CRAM is going to continue to be in business. And I'm sorry? Yeah, it wasn't acquired in the last 5 years. And even though this is pro rata, 302E4 says that's fine. And even if there's no stock, actual stock, they just get the assets of BAR, should still be treated as exchange treatment, right? Because what's the difference if they give up shares or if they don't give up shares? Meaning it should still qualify for partial liquidation treatment, and they will get exchange treatment. All right, so your answer on page 240 to problem A is that this will qualify as a partial liquidation to M&P, but not to IRIS. Insofar as IRIS is concerned, IRIS has an extraordinary dividend here. Question B, is there a different result in A above if A had purchased book 3 years ago for cash? If so, why should that matter? What if Alpha acquired books 3 years ago in a tax-free exchange? Say again? Gary, you agree? I'm sorry, Gary?
No, I'm not sure.
Not sure? So, 5 years, right? It's got to be 5 years. So this does not work. But what happens if it was acquired in a tax-free exchange? I'm sorry? Well, if it's tax-free exchange in a corporate reorg context, Code Section 1031 or 368, that will work, because if you notice the language, it says it can't be acquired in the last 5 years in a taxable exchange, right? So if it was acquired in a tax-free exchange, and presuming that other business was held for more than 2 years before that, that should be okay. So your answer to B is, if it was acquired for cash 3 years ago, that doesn't work, because that looks like a bailout. It looks like they're using their cash as a stratagem to try to, instead of distributing cash, they'll buy a company, and then they'll distribute that division out. So that doesn't work. How about, so M&P no longer qualify as a partial liquidation. And if it were tax-free, that would work, right? Because look at the language under 302 E2. E3B, capital letter B, where there was gain or loss recognized in whole or in part. If it was tax-free, Michelle, there's no recognition. So here, if it doesn't work, meaning there's no partial liquidation, then IRIS is just under the normal 301 rules, right? We just examine whether or not the amount of the dividend, the holding period, if we're not sure if 1059 applies here, because it's not a partial liquidation, and M&P, it no longer qualifies for partial liquidation treatment. And since it doesn't qualify for partial liquidation and their percentage of stock ownership hasn't changed, guess what? You got to fit within B1, B2, or B3, right? In other words, if it doesn't work by looking here at the corporate level, we have to look above, right? And see if it qualifies under B1, B2, or B3. And guess what? If their percentage ownership is the same before and after, is this going to work? No. B1, B2, and B3 are not going to work. So for your notes regarding question B, this does not work, except with the caveat, except if it was acquired in a tax-free exchange. But putting that issue aside, this does not qualify as a partial redemption. Larry, you had your hand up. Okay. Right. I mean, and we'll see an example of that, because there may be other ways to meet this test.
So in this question, didn't qualify as a qualified trader business, but if there's the other way around, that falls under the not related to.
I don't think that's what they're referring to. I think they're talking about the word ceasing, and we'll see in a moment what that means, okay? So hold your question on that. All right, so for your notes, guys, example A or question A, is supposed to give you an illustration of where there's really a nice partial liquidation of a business, right? You're operating two divisions, they're going to cease operating one division. It has a very strong aroma, right, of being a partial liquidation.
I just have a more general question. So we're analyzing it at the corporation level.
Absolutely.
But it's still applying to the non-corporate shareholders. So from N&P's perspective, it would be a partial, like, I'm just trying to determine who has the partial liquidation.
Definitely at this level. These guys are not partially liquidating anything. They're getting assets.
Okay, so we're looking for the corporation level. But you're saying that it applies to N&P but not IRIS, so I wasn't sure.
We're looking to see if there's a partial liquidation at this level. And if there is, that triggers exchange treatment under 302(b)(4. Okay? But not as to IRIS. IRIS has to look elsewhere. If IRIS can't find anything else, it's just, as Andrew would say from the beginning of the chapter, then we're back to chapter 4. It's just going to be considered a distribution as to IRIS, right? And then we have to apply Code Section 1059. Okay. Question C. What if all the assets and books were destroyed sadly by fire, and Alpha distributes 1/2 of the insurance proceeds equally to its 3 shareholders, a redemption of an approximate number of shares of stock, and retains the remaining proceeds to carry on its book publishing business on a somewhat smaller scale? So you get the visual. Add this fire, destroyed a portion of the books division, but not the entire thing. And they're going to distribute out those proceeds. Does that constitute a partial liquidation? And Larry, I'm going to ask you, because you raised the question before. Does it count as to IRIS as a partial liquidation? No. Everyone agree? Right, Allie? Can't count towards IRIS because IRIS is never going to get exchange treatment under the partial liquidation. Right? Right. What about as to M&P? Now, Larry, is the business being terminated? No, right? It's smaller. It's not ceasing to do business. Everyone agree? Now, in that particular case, can we still satisfy E1? Does this feel like a partial liquidation? Right? It's smaller, right? The business is big. Everyone agree? Notwithstanding my lack of artistic skill, in some form or fashion, this square or whatever you want to call it is now becoming smaller. We've lopped off a portion that was destroyed by fire. And that has an aroma, maybe from the smoke, of being a partial liquidation. So, with this, and the authors in the material that precedes this, right, they refer to a fire, right? I forget, there was a case or something, right, Christina? I'm sorry? 3. What was that site too? Is that what they? I thought you're right. Yeah, they use the congressional notes. But Larry, you found another site. I don't know where you found your site to. Janine? 302 what? E2. B, but that won't work because again we didn't cease to do business.
Yeah, but it says, after the distribution, you conduct another business.
But, okay, we met that leg, but we didn't meet leg A, and it's a conjunctive test. You got to meet both, right? But you still can fit in the definition of E1 and the congressional history suggests that this should work. Okay, so your answer to question C here, guys, is that to M&P this should work. As to Iris, it will not work. Why? Because it has the feel of 302E1, where it meets the distribution is not essentially equivalent to a dividend, right? Determined at the corporate level, not the shareholder level, right? This doesn't feel like the normal, when a company gives a distribution or gives a dividend, does it constrict in size where it gives up a portion of its business? And the answer is no. Everyone agree? So this has a very different feel to it. When a company normally gives a distribution, does it cease operating part of one of its divisions? No. In this case, it did cease not the entirety of this division, a portion that has a very different feel to it, right? And as a result, should qualify as a partial liquidation. All right? So for your notes, should work, right, Larry?
346.
Right.
This exact.
And just out of curiosity, how did you come across that?
So
The supplement? Okay. I'll take it any way you can get it. So let me look at it just with you. 346 what?
-1, it's called partial liquidation.
Okay. And
It's A.
346-1A what?
It's just in the textbook code, reason why.
Okay, an example of a distribution which will qualify?
Yeah.
You're talking about under 3 little I?
Yeah.
So 346-1A2, 3 little I, right there.
Yeah, it's the text underneath, it says example of the distribution. So such as the distribution of unused insurance proceeds to cover the remaining back.
Okay. All right, good. I'll go with it. I don't know how different code sections you need to tie together. Like, what was the bridge to get you to 346-1? If you see what I'm saying. In other words, what's the authority when you're under 302 to get to the regulations under 346? So I'm not. Personally, I would say to the legislative history, but if you can connect the bridge, I'm more than open to this. All right. Question D. Same as A, except that Alpha distributes the assets of books to Michael in redemption of all of his stock. Okay. Does this work as a partial liquidation? And Wafa, would you agree? Would this work? You say that with such conviction. Allie? Priscilla? Does it work? Priscilla? Angie? JP, does it work? Why do you say all? Does it have to be all the assets? Does it work, Brian? Shirley? Does it work? It does or doesn't, Shirley? Why not? Before we looked at B4, what might you consider working under? B3, right? Hasn't the husband been terminated here? Everyone agree? Don't lose sight. The husband's been terminated, right? Right? Right, he would. So what might you do in that instance, Brian? What? You like my visual? You might do a waiver, right? 302C2, right? Do a waiver. Do you need to? In other words, that's a pain in the neck, right? So what might you argue here, Brian? Might you just invoke 302B4 and just say it was a partial liquidation? Can this work as a partial liquidation? Has this enterprise given up one of its divisions? Sure. And if you go through, Brian, B4 instead of B3, you don't have to do the waiver. Go ahead, Shahid. No. You do not have to get the waivers. B3 connects you up with the waiver rules. Okay? B4, there's nothing there. If it qualifies as a partial liquidation, it qualifies. Game over. Right? Because you're examining, right, Shahid, at this level, not at that level. You don't have to worry, even by attribution, that the husband still owns 50%. It doesn't matter because that's not what the test is. We're not looking at the shareholder. B1, B2, and B3 look at what the shareholders own before and after, right? B4 looks just narrowly right there. And if it's smaller and the shareholder's not a corporation, it should qualify under B4. That's it. Game over. All right, so for your answer for D, qualifies. Question E, same as above, except that Alpha distributes the assets of books to Iris in redemption of all its Alpha stock. So ITSA, does this work? Does this work, ITSA? Why not? Edwin? Christina, you got a smile on. So what?
So it's not partial liquidation,
What, Fanta, you're going to say? You guys talk loudly. No one behind you can hear you. You guys are getting very fixated, right, on B4. Oh, yeah. Come on, Fanta, so where does your brain take you now? Say again, Michelle? Is that you? Kevin? B3. Christina? Eeyore? You're shouting out, it's a corporation. Who cares? B3, it's been terminated. No buts. You'd be right, but you'd be sued. All right, guys, you know, you can't be a little right here. You got to be 100%. You're right. You're right. B4 doesn't apply. Right, Christina? But if you overlook B3, that's not a happy day in the office. All right, everyone have that in their notes? It will qualify, but just because, you know, your clients do not come in with, you know, partial liquidation on their forehead. So you got to just keep in mind that you got to keep an open mind, right, Fanta? That what do they say? The world is your jewel, or you got to just, anything can happen. and B3 might apply here. And it does. So Iris will get complete exchange treatment. F. Alpha distributes the securities portfolio to its 3 equal shareholders in redemption of 20 shares from each. Does this work as a partial liquidation? Fatima, Israel, does it work? If the securities are given and they're given in exchange for 20 of the shares, does that work? Fanta? And Fatima, you were going to say? Say again, Fanta? Well, it's distributing securities, so it's less valuable, right? Right? It used to own the securities, now it won't, so it's less valuable. But does it qualify as a partial liquidation? And the answer is no. Why? It's not a qualified trader business, right, guys? Securities are managed passively, right, Joanne? So it's not a qualified trader business. It's not actively traded, actively managed, right? And where do we get that from? What code section talks about it? 302E3. Actively conducted. Securities don't work. So what happens here? It's treated, right, Andrew, as a normal distribution, right? And we'll evaluate depending on earnings and profits under code section 312. And then we'll look at 301C1, 2, and 3, right? In other words, guys, you can't just ignore chapter 4 and say, gee, there won't be too many questions on chapter 4. I can just focus on 5, 6, and 7 for the exam. Because anything that we're doing now, if it doesn't work under chapter 5, you're back to chapter 4. Everyone agree? So this doesn't work, which brings us back to chapter 4. Question G. Alpha sells all of its beta stock and distributes the proceeds pro rata to the shareholders in redemption of 20 shares from each. Let me say that slowly. Alpha sells all of its beta. That's this. Remember, this was a subsidiary. This is a bad magic marker. That's a subsidiary. Subsidiary company. Compare and contrast that to H. In question H, it says same as G above, except that alpha liquidates beta and distributes the assets of the beta business, which beta has operated for more than 5 years. So the difference between question G and H, in G, alpha sells the beta stock, gets cash, and distributes the proceeds. Question H, alpha liquidates beta, so now alpha liquidates beta, so now alpha is a bigger entity, right? And then, as a result, once it's a bigger entity, then it's going to distribute its assets to its shareholders of the beta business. Okay, to get the visual on this, one is selling stock, the other is it's liquidating first and then distributing the assets of beta. So, given that, does the first or the second transaction work in this context? The second one works, and why? What's our authority? The revenue ruling that immediately precedes this, right? 79-184. That's why we said, right, that form governs over substance here. It's essentially maybe getting into the same end, but it doesn't matter. In this case, we have a revenue ruling that says if you go through this step of first liquidating the sub into the parent, and then you distribute the assets of the bigger parent to the shareholders, it will work as a partial liquidation with the caveat that Ihor, you're supposed to say very loudly that if it's a partial liquidation as to Iris, it won't work, right? Because that doesn't work because it's a corporate shareholder.
So that, the revenue one, that doesn't consider the relationship and stuff, it's just the method of liquidation.
I'm not sure if I.
Well, that's wrong, I looked at it wrong. It looks like two different structures.
No, once the subsidiary is, it's really one and the same now. The subsidiary only exists as a division under the parent. It's not a separate legal entity anymore. Okay? Okay, so now, guys, you can say, I don't know, with a great deal of comfort, I'd like to think so, that you know how to apply Code Section 302, B1, 2, 3, and 4. Wow, look at that. And not only do you know B1, 2, 3, and 4, you also know that to get to there, you have to generally, except for B4, apply for B1, 2, and 3, Code Section 318. All right, so you have to organize it in your notes. You have to organize it in your summary for this chapter. But everyone here can handle 301, B1, B2, and B3, and B4. And it talks about the consequences. Generally, what we've looked at is the consequences here to the shareholders, even though for partial liquidation, we had to look at what was going on here to determine the consequences here. I'll repeat that. To determine under B4, we didn't look at the tax effects of the corporation. We looked here to determine still what were the tax effects above. What the next segment of the chapter wants to do, or attempts to do, is to say, okay, we're going to have a liquidation, and we've looked at the effect to the circle or the square if it's a shareholder. What are the effects to the corporation? Right, Matt? Back to you. And we want to know all the effects to the corporation. And I'm glad everyone's sitting down, because what are the big effects to the corporation, do you think? E&P is one, and what's the other one? Does it have any gain or loss, right? So, Matt, a complete answer on an exam would not just be what is the taxable income. It would also include a segment of what effect to the earnings and profits of the corporate entity, right? Just like what we, right, in Chapter 4, when the corporation distributed cash or property, we looked at the whether or not the corporation experienced gain or loss, right? What code section, Matt? 311, right? 311. And then, Hannah, what other code section do we apply? 312, right? Right? Rarely do you get peanut butter and jelly so close together. You have 311 and 312 neck to neck. Now, when we deal with redemptions, guys, same exercise, right? How do code section 311 and 312 apply? And Alice, how does 311 apply? John, how does 311 apply? Sharon, how does it apply? 311. If you have a corporate redemption, what do you think? The song remains the same. Gains are going to be recognized, losses disallowed, right? So if this company uses appreciated assets, right, it doesn't, when there's a redemption, must it use cash? When a company redeems the assets from a shareholder, the shares from a shareholder, it can use plasma TVs, it can use cash, it can use whatever, tractors, right? And that redemption, by using appreciated property, will often give rise to gains, but losses are disallowed. All right? How about to earnings and profits? Anna, what about earnings? What affect to earnings and profits? What happens? Okay, tell me more. Mabu? How does it get adjusted? In very simple terms, Mabu. You going to say something, Shahid? When a company redeems its own shares, what effect, what bearing does it have on the company's earnings and profits? When I say to this company's earnings and profits when it redeems shares, that qualify for exchange treatment. Now, if the distribution doesn't qualify for exchange treatment, what affects to earnings and profits? We're back to chapter 4, right? And we may reduce earnings and profits by the amount of the distribution, right? But when it comes to an exchange, okay, what's your authority? In other words, what Christie says is we're going to reduce earnings and profits of this enterprise, and not any earnings and profits, only the accumulated earnings and profits. Only the accumulated earnings and profits as of that date by a pro rata amount of the proportion of shares being redeemed. So very simply, if 25% of the shares are being redeemed, earnings and profits will dip by 25%, just to oversimplify it. And your authority for that is Code Section 312 N7. And it can never be reduced by more than the amount being paid out. Okay, so it's the lesser of the percentage or the amount being distributed. Okay, the lesser of the two. Excuse me? Well, that's true, but that's always the case with earnings and profits. Will always be reduced by any taxes that are due and owing. All right, now, so the takeaway about this is twofold. There's an effect under Code Section 311, right? Gains recognized, losses disallowed. And there's a secondary effect, Code Section 312 N7, that there's a proportionate reduction of accumulated earnings and profits. Now, the authors on page 242 and 243 go through a fairly simple example. For exam purposes, Irma, you may want to note, right, Irma, is I would try to keep it at the very simple level. I will be happy if you can, in general, just reduce earnings and profits by the proportionate amount. In the revenue ruling 74-338, you know how sometimes I talk about revenue rulings, the one that concerned, for example, where someone contributed multiple pieces of property, got back boot, and we had to do a pro rata allocation. I said, you guys really should hone in on that, read that revenue ruling 2 or 3 times. I will be happy if you read this revenue ruling at least once, but you're not going to have this come up in practice. The one, I don't think you're going to have this come up in practice as much as the one that pertaining to the receipt of boot where you contribute multiple pieces of property. You guys can go through this. It is not the most complicated math in the world. You just have to be patient and figure out when the distribution is being made, what point in the year. We'll go through a fairly simple example and the problems that follow. But if you go through this, they're just trying to figure at the time the distribution is made, they're going to take what the then current earnings and profits are at the time the distribution is made, transform them into accumulated earnings and profits, and then reduce those now accumulated earnings and profits in a pro rata fashion. So I don't want to say you're on your own. You're on your own because it's pretty self-explanatory, but you wouldn't look for anything this complicated on your final exam, okay? Let's look at the problem on page 246. 246 has 200 shares of common stock, A and B, who are unrelated. Each acquired 100 shares of X upon their issuance at a purchase price of $1,000 per share, and they each thus have an adjusted basis of $100,000, right? They have 100 shares times $1,000, so their adjusted basis is $100,000. At the beginning of the current year, X has $100,000 of accumulated earnings and profits, and X has $100,000 of current. Everybody have that? In my margins, I've always told you guys, unless you have great memories, it doesn't hurt to write this out. So at least in my margins, I have $100,000 of accumulated, $100,000 of current earnings and profits from operations during the year. What are the tax consequences to X? That means to the corporation. Notice, we are not asking the tax effects to the shareholder. If on July 1st it distributes $250,000 in redemption of A shares in a redemption that qualifies for an exchange. Now, assuming it does, for a second, Cassandra, what code section would this fit within? In other words, what treatment does A get and why? Forget about the treatment of the corporation for a moment. Just what tax treatment does A going to have, right? Because we have two shareholders. Do we have three? A and B. And I just want to know why, Cassandra, the conclusion was drawn that says the redemption of A shares qualifies for exchange. Why? So again, I think I like what I hear you saying, but right, 302B3, right? Termination. Okay, and A and B are unrelated, so they're not married, so we don't have to worry about attribution rules. Agreed? Everyone see that? 302B3. But that's not the issue du jour, or for the moment, okay? So in this case, Mercy, Akash, Janine, tell me how much will the company's earnings and profits be when all the dust settles. So just take 15 seconds, everyone try to come up with a number. How much would earnings and profits be reduced as a result of this redemption? Mercy, Akash, Janine, what do you guys say? Earnings and profits get reduced to what? Mercy says 0. Akash? 0. Janine? $75. Guillermo, Larry, you guys agree or disagree? Guillermo, Larry, other Larry? 50,000. Kareen? Do you have a number in mind, Kareen? 75. Howard? Well, look, notice the time period, guys. When this is happening? July 1st, last we checked, it's halfway through the year, right? At the moment of July 1st, we know what accumulated was 100, right? At that moment, what is current? 50. Together, is 150, right? What percentage of shares are being redeemed here, Larry? 50. So I think it's fair to say at that moment we're going to reduce earnings and profits down by 75, right? Everyone agree? We have 100, which is accumulated, and at the moment of July 1st, 50 current. We're going to treat that as accumulated. That's what the revenue ruling says. And then, as a result of that, it will be 1/2 the shares under 312N7 for your notes. Everyone can handle that? All right? That's it. Just keep it simple. Nothing too complicated.
This is cash.
Right.
If they distributed appreciated property, you have to
I would adjust.
gain immediately before the
I would treat that. So Christy says, suppose they use property that a tractor with an adjusted basis of 10, fair market value of 100, and they use the tractor to redeem our A shares. I think you have a $90 gain recognition right to the corporation, right, Matt? That you wouldn't want, but you wanted to go beyond that and increase earnings and profits by 90. Now, I wouldn't, Christy, I'd had to think about this more, but I remember none of this can be done until the end of the year. So I would just say that earnings and profits went up by that. I wouldn't say that 90 would be targeted right before. You know, I don't know if what philosophy would prevail here. I would just say that at the end of the year they had now 190. I would do it 50-50. Right, the proportion of shares. And here, half the shares were redeemed. Not because we have two shareholders, they happen to each own half the shares. If A owned 1/3 and B owned 2/3, then there's two shareholders, but E&P, I would argue, would only go down by 1/3, right? And you would, I hope, agree. This is a pro rata reduction of the number of shares. So if A had 100 shares and B had 200 and A shares were redeemed, it's 1/3. If A had 100 shares and B had 200.
Okay, no, I mean, I'm talking about.
Okay, that's fine. Yes, 1/2. No, but remember, it's not 200 times the percentage. It's the accumulated earnings and profits at the time the redemption occurs. At the time the redemption occurs, we have the 100 of accumulated plus 50 of current. That's 150, and that's why we're reducing it down by 50% of 150, not 50% of 200. Okay? Michelle? I'm sorry? Right. But if you use appreciated property, you have a gain recognition under Code Section 311, right? And then you would have to add that to current earnings and profits. At the end of the year, you would see it, instead of being 100, it'd be 190. Then I take, as of July 1st, I'd say it's 1/2 of that, or 95. Go ahead, Matt.
Good question. Just to put in the example, the lesser of, so in this case, the distribution was 250K, which obviously 75,000 is less than 250. If the distribution was 50,000,
You'd be capped at 50.
it's capped at 50, it would be the 75.
Right. Can't be.
Okay.
Okay.
But like, how do you know, like, the current earnings and profit is?
You don't know until the end of the year. At the end of the year, you'll know what the current earnings and profits are, and then you'll do a pro rata amount up until that time of the year. Yeah, absolutely. And if you look at the revenue ruling that precedes that, that's what the revenue ruling does. All right? So, guys, that's page 246. on page 247, we know Code Section 162 is an oldie and golden oldie. 162 talks about, if you recall, right, the famous Welch v. Halvorin case, right? Talks about whether or not certain things are ordinary trade and business expenses, right? And if they're not trade or business expenses that are deductible, I just want to take hand in hand down memory lane. Lee, you want to take my hand? Where do we go? What kind of baskets? There's 3 baskets we talk about when we talk about expenses. Where can they go? Just want to remind people. Tyler, did you? You have an out-of-pocket expense. What 3 baskets can they go in? Shahid? 162? No, that's not a different basket. No, that's a gain or loss, or losses should be allowable under 165. Just talking when you have an expenditure. Generally, there's 3 different baskets. What baskets can they go under? Well, no, 195 is a straight-up expense. 212 is an investment expense. I'm just talking in the context of a trade or business. 263, they could be capitalized, or 262, they could be a personal expense, right? All I'm saying is I want to remind people, when your client comes into you and they talk about expenses, they can go into 1 of 3 baskets generally, right? Now, Christie says, too, I mean, if you're dealing with someone who's investing, not a trade or business, you could have a Code Section 212 expense, right? But generally, we had 3 baskets. Agreed? 162, sometimes those expenses have to be capitalized under 263, or sometimes they're personal expenses, right? You go out for your Starbucks coffee, that's not deductible, Code Section 262. Code Section 162K deals, right, it's under the umbrella of 162, right? And does it, when it comes to redemption expenses, are they deductible? And what we're told here is they are not. Everyone see that? Amounts paid to acquire stock generally must be capitalized as part of the stock basis. And the authors go on and point out Code Section 162K1 was enacted to make it clear that all expenditures by a corporation incurred in purchasing its own stock, whether representing amounts paid for the stock, a premium paid in excess of the amount of the stock's value, or expenses connected with the purchase, are non-deductible, non-amortizable capital expenditures. Okay, and it's pretty broad. Notwithstanding its breadth, there's been some debate, and on page 248 at the very bottom, it points out that interest payments to finance the purchase of stock, the interest component remains deductible. Okay, so generally, redemption expenses, not deductible, have to be capitalized. But if you have any finance charges in connection with the redemption, those are generally deductible. Page 249. So now we're moving on. And what I mean by moving on is the authors now want to give you a heads up on, hey, now that you've learned about B1, B2, B3, B4, and now that you know the effects to the corporation under 311, you know, when you're doing the outline for this chapter, you're going to have, 311, of course, and 312 N7, right? But now that you are, mastering all the material about redemption, how does it apply? And the authors talk about different redemption planning techniques. And they go through, page 249, ways that shareholders who are trying to get a new shareholder in might have some of their shares redeemed. They might sell some of their shares and then have it redeemed. They also make reference to a case on page 249. It's an old one called Zenz. Everyone see that? It's the last incomplete paragraph. And this, if we were to take a step back in time 30, 40 years, probably the authors of a case book back then, Zenz would have been one of those cases they would have spoken about probably at length. Here was a shareholder of a company, and just pretend this is a Mrs. Zenz, sold part of her stock in the company. Let's just suppose she sold 80% of what she owned in the company. And let's just suppose she was the sole shareholder and she owned 100 shares and she sold 80 of those shares to me. Okay, get the visual. So now I own 80% of this company, and no offense to Mrs. Zenz, I don't want her there anymore. I don't want her to be a minority shareholder. And I redeem out her remaining, when I say I instruct the company. I look in the mirror, I am the president, I am the board of directors, and I say, you know what? We're going to take Mrs. Zenz out of the picture. We're going to redeem her 20 shares. And we do. And her shares are redeemed. How should that be treated? The sale to me of 80%, I'm an unrelated party to Mrs. Zenz. How should that be treated to Mrs. Zenz when she sells 80% of her stock? What kind of tax treatment should she have in that kind of context? Should she have, what would you anticipate? What code section becomes operative? 1001, right? Everyone agree? She sells 80%, 1001. Agreed? All right. What about her 20% of the shares redeemed? How should that be treated? She's been terminated, right? 302B3. We're all on the same page. Agreed? And, the effects of the corporation are, 311, 312. But her effects, she's been terminated. Suppose you reverse that transaction. Suppose Mrs. Zenz had 20% of her shares redeemed, and then she sold 80% to me, her remaining 80 shares to me. Would her 20 shares that were redeemed qualify for redemption treatment? No. Why? So before and after she held 100%. Agreed? So it doesn't qualify under B1, B2, and B3. We're not even looking at B4 because we didn't even talk about partial liquidation. The IRS in the Zenz case said, you know what, Mrs. Zenz, that was pretty tricky of you to sell your stock and then force a redemption. We think that's a step transaction, and we think it should be where your 20 shares were treated as a distribution taxable as a dividend. The IRS does not prevail in that case. And if you look at the very bottom, it says, the U.S. Court of Appeals rejected the government's contention and held that the purchase of the stock by the corporation, right, that's a redemption, was not a dividend to the selling shareholder, and the proceeds should be treated as payment for the stock surrendered under the Internal Revenue Code of 1939. So it respected the timing. And what the IRS does in this revenue ruling is essentially says, you know what, we were wrong. We got it wrong. And on page 250, essentially the IRS is going to say, on a going forward basis, we don't care what order you do it in anymore. This is a pretty big concession on the part of the IRS. Revenue ruling 55-745 states situations similar to Zenz, the amount received by a shareholder from a corporation will be treated as received in payment for the stock surrendered under Section 302 of the Code, since the transaction, when viewed as a whole, results in the shareholder terminating his interest in the corporation within the meaning of Section 302B3. In other words, the IRS now is making a big concession. It's saying even if you have your shares redeemed beforehand, and it's all part of a plan where you are going to have your shares sold immediately thereafter, that's okay. So essentially the IRS is saying, we don't care what order you do it in. At the cocktail party, you can talk about your client being Zenzed out, right? It's now become like you can Google something, you can Zenz Zens out a shareholder. And if you ask where that comes from, you now know. People in the know will talk about a Zens being Zensed out. Okay? All right? So ordering there does not matter. Essentially on page 250 it says, look at the whole, look before, look after, and see when all the dust settles, what percentage does the shareholder own, okay? Look at the whole picture. On page 251, there is something you've seen before in some form or fashion where we had a corporate shareholder. Now Strap is an individual shareholder. We have Strap is the sole shareholder of Target. Boot is looking to buy Target. But Boot, as you recall, can't pay the $500,000 purchase price demanded by Strap, even though he believes it to be fair. Target has more than $100,000 in accumulated E&P and $100,000 of cash on hand. Should Strap and Boot structure Boot's acquisition of Target along the lines of Zens? In other words, should some shares be redeemed, some invested shares redeemed for $100,000, redeem some of these shares for $100,000, then have Boot buy the balance, right? Would that qualify? It would. Under Zens, that would work, right? If you have, last I checked, 100,000 is what percent of 500,000? 20%, right? 100,000 is 20% of 500,000, right? So if S owns 100 shares, how many shares would be redeemed? 20 shares. Everyone agree, right, Panta? 20 shares would be redeemed. What effect would that have on T's earnings and profits? A redemption of... It would reduce earnings and profits by 20%. What's our authority for that? 312N7. Everyone agree? Does 311 have any impact? No, we're using cash. Everyone agree? Chloe, you got this? The authors are just trying B. Wish I had a pen that worked, but B wants to acquire T. Doesn't have, I think we said B only has 400,000, so some way T has to shed 100,000. S could sell 400. Let's think about this. S could sell 80% of the stock to B. Okay, could sell 80% to B, get exchange treatment, and then we could flip it, and then we could have the redemption of S stock that follows. Right? Everyone agree? In other words, look, I don't want to belabor this problem on page 251. The author's point is, how does Zens impact this problem? The Zens case impacts it in saying that it doesn't matter if the redemption comes first or the sale comes first. Everyone agree with me on that? Doesn't matter. You could sell 80% and then have the redemption of the 20% that follows. Or alternatively, she could, meaning S, could have 20% of her shares redeemed for $100,000 followed by a sale. As long as it's part of a plan under Zens and this revenue ruling that immediately precedes it, 75-447, we're good to go. The second takeaway from this problem is, as a result of engaging in this transaction, the earnings and profits of T will be reduced. Reduced under what? Code Section 312 and 7. That's all I care about this problem. I don't want to. There's some other issues we could raise about what is S's basis in T, because that could, but I think that will only confuse what we need to, for our purposes, what we need to discuss. Earnings and profits will be reduced by 20%. Accumulated earnings and profits we'll have to see, right, Christina? When in the year, right, Irma, this happened, right? Because depending if it happened at the beginning, middle, or end of the year, we'll have to take whatever the current earnings and profits and stuff it into accumulated earnings and profits, right? And then reduce it by that percentage. No, the exact opposite. Only accumulated to that date. All right? Now,
We're talking about the exchange redemption. Does that apply to the entire transaction? So you just kind of wait out earnings, or it just
you're not going to wait.
redemption,
It's just the percent that's redemption,
not the sale?
not the sale. Sale is,
It then qualifies the entire thing.
it qualifies the entire thing for exchange
The
treatment
accumulated reduction is just for the redemption.
for the redemption. Absolutely. Michelle, you had a question. All right. The point is that the only reduction of earnings and profits to the target will come vis-a-vis the redemption. The exchange portion has, when you sell your stock to some third party, does that have any bearing on the company's earnings and profits, guys? No, right? If you sell your stock to some third party, will have no bearing. Whomever buys it will take that company with whatever earnings and profits it has. There will be no adjustment. There's no adjustment under Code Section 312 for whom, in response to an exchange. Now, after the break, guys, here's our goal. We will look at buy-sell agreements and their importance. We will look at what happens with a divorce, what happens with a charity. We will then turn our attention to a very, how do I say it, complex code section dealing with Code Section 304. And one that I'm telling you, in the years I've practiced, it comes up in a way that can scare you. And when we talk about this case, you'll see its implications to the practitioners. And then, time permitting, if we finish this chapter, we can have a short discussion, or preliminary discussion in Chapter 6, just to set the tone for what we hope we'll be covering on Saturday. So why don't we take our 10-minute break, and I will see people then.